A. Calculate rates of return. Rates of return measure the percentage gain or loss on an investment over a specific period. The basic holding period return includes price appreciation plus dividends or cash flows divided by the initial investment. Candidates must calculate simple returns, average returns, and weighted returns when multiple periods or investments are involved. Time value of money affects return calculations. When evaluating multi-period investments, geometric average return is preferred over arithmetic average because it reflects compounding effects. Total return includes income and capital gains. Ignoring dividends or interest income understates true performance. Return calculations support capital budgeting and portfolio evaluation. Accurate measurement allows managers to compare investments, assess performance, and determine whether objectives are achieved. Understanding return measurement forms the foundation for analyzing risk-return trade-offs. B. Identify and understand systematic market risk and unsystematic company risk. Systematic risk affects the entire market and cannot be eliminated through diversification. Examples include economic recessions, inflation changes, political instability, and interest rate shifts. These factors influence most investments simultaneously. Unsystematic risk is company or industry-specific and can be reduced through diversification. Examples include management decisions, labor strikes, product recalls, or competitive pressures. Diversification reduces unsystematic risk but not systematic risk. A well-diversified portfolio eliminates firm-specific volatility while still being exposed to overall market movements. Understanding these risk types helps investors structure portfolios appropriately. It also explains why required returns compensate investors primarily for systematic risk. Risk classification improves capital allocation and strategic financial decision-making. C. Identify and understand credit risk, foreign exchange risk, interest rate risk, and market risk. Credit risk refers to the possibility that a borrower will default on obligations. It affects lenders, bondholders, and suppliers offering trade credit and influences required yield and pricing. Foreign exchange risk arises when cash flows are denominated in foreign currencies. Exchange rate fluctuations can increase or decrease reported profits and asset values. Interest rate risk impacts fixed income securities and borrowing costs. Rising rates reduce bond prices and increase financing expenses, affecting profitability and valuation. Market risk reflects overall price fluctuations in equity or debt markets. It encompasses macroeconomic changes and investor sentiment shifts. Identifying these risks supports effective hedging, diversification, and capital structure decisions. D. Demonstrate understanding of the relationship between risk and return. The fundamental principle of finance states that higher risk requires higher expected return. Investors demand compensation for bearing uncertainty, especially systematic risk. Low-risk investments, e.g., government securities, offer lower expected returns. Riskier investments, such as equities or speculative ventures, must provide higher potential returns to attract capital. Risk-return trade-off guides capital budgeting and portfolio management. Projects must generate returns exceeding their risk-adjusted cost of capital. Diversification improves the risk-return profile of a portfolio. It reduces unsystematic risk without proportionally reducing expected return. Understanding this relationship supports rational investment decisions, valuation analysis, and strategic financial planning.